Welcome to the Trader's Bulletin Margin Trading course. This short video will ensure you know what margin is and how to use it safely. The information contained in this course is based on current UK spread betting regulations. Please bear in mind that these regulations can change, and different brokers may have different ways of working. Trading on margin or using leverage is about the use of debt to increase profits. It's a powerful way to invest your money, but it's vital to understand how to do this safely. Margin is used in many walks of life, in good ways and in bad ways. Here are a couple of examples. This is Tom. He's got a tip on a horse running in the 310 at Lingfield with odds of 20 to 1. Tom is going to put all his money on it, but he's only got £100 in the bank and he needs to make more than that. He's got some loan sharks on his back from the last time he pulled this trick. So Tom persuades 9 gullible friends to lend him £100 each. He shows each of them his £100 to prove that he'll be able to pay them back. Now he heads off to the racetrack with £1,000 in his pocket, ready to put it on sure thing at 20 to 1, hoping to win £20,000. He's 10 times leveraged, and his friends have only asked to see a margin of £100 before giving him this leverage. If Tom's horse doesn't win, he's not going to have any way of repaying his friends or those loan sharks. But margin is also used in more sensible ways. Here's Anne. She's buying a house and her bank has asked for a 10% deposit. This means that she's 10 times geared or leveraged on this investment. If the value of that house increases by £10,000, Anne gets all of that equity boost despite only putting down a deposit of 10% of the value of the house. I hope this demonstrates that margin can be useful when used wisely, but if used blindly, it can get us into all kinds of trouble. As spread bettors, we use margin all the time. That's how spread betting functions, but we shouldn't use it to overextend ourselves. Instead, it's to maximize the potential of our money. And we have ways to protect ourselves from the downside, which I'll come to in a moment. First, I want to show you how we make money from spread betting. Let's say that I want to invest in the stock market. So, I'm going to buy into the FTSE. A buy trade is also called going long. Let's say that its current price is 8,000. But I'm not going to spend £8,000 to get in on this. I'm going to place a bet of £1 per point. I want my broker to pay me £1 for every point the FTSE moves in my favour. So, if the FTSE rises from 8,000 to 8,100, I'll have made £100 profit. If I'd staked at £5, then I could have made £500 from the same market move. The potential profit or loss is calculated from how many points the market has moved, multiplied by the stake. Spread betting also allows us to make money from falling markets. If we believe prices will fall, we place a sell bet. This is also called going short. So, if the French stock market, known as the CAC, was trading at 7,100 and I believed the price could fall by 50 points, I could sell the CAC. If I placed a sell bet with a stake of £1 and the market fell by 50 points, I could profit £50. If I'd used a stake of £10, then I could have made £500 from the same market move. So where does margin fit into this? Margin varies enormously from one instrument to another, depending on the stability and volatility of that instrument. The FTSE, for example, will have a relatively low margin requirement of 5%. However, if you look at small cap shares or Bitcoin, you'll be asked to deposit up to 50% margin. To place either of the trades described above on the FTSE, my broker asks for 5% margin. So, to trade an instrument with a value of 8,000 at a stake of £1, it would cost me £400. By comparison, if I'd traded the FTSE directly, I'd have needed to spend £8,000 for the same level of investment. In this way, spread betting allows me to access profits from a market that I might not otherwise be able to trade. It is an incredibly powerful way to maximize the profit potential of our money. But this upside is balanced by a potential downside. If the value of the market I'm spread betting falls sharply and I'm in a buy bet, I could find myself losing a lot of money. This is why spread bettors should always trade with a stop loss. Here's how we do that. A stop loss is an instruction to your broker to automatically close out your trade if the market moves against you. In this example, I've entered a buy trade at 8,000 with a stake of £1. In case the price moves against me, I'm going to place a stop-loss order at 7,900, instructing my broker to automatically close my trade if the price drops to this level. The risk on my trade is measured by the distance to my stop-loss multiplied by my stake. So if I'm trading with a £1 stake and a 100-point stop distance, then my potential risk on that trade is £100. A profit limit is another instruction to your broker to close out a trade, but this is for taking profits rather than controlling losses. It's a useful way to manage trades hands-off. So, if I'd set a profit limit at 8,100 and the price had instead nudged up here, then my broker would have automatically collected those profits for me at this level. If you open a trade with a stop loss and a profit limit, your broker will automatically close that position if the stop is hit, for a loss, or if the profit limit is hit, for a profit. You may have heard about slippage. Slippage is what happens sometimes when markets are moving quickly. It means that your broker is unable to close, or open, a trade at the level you've requested. When your stop loss suffers from slippage, it can mean that you're taken out at a worse price than you were expecting, and your loss on that trade can be greater than you'd expected. Some markets are more volatile and more susceptible to slippage than others. One way to protect yourself against slippage is to use a guaranteed stop. This means that your broker guarantees to take you out at the level you requested. However, you have to pay your broker extra for this kind of stop. A margin call is what happens if your trading account is running low on margin. This can happen if your trades start to lose money. For example, if we've entered a buy trade at 8,000 with a £1 stake, our margin requirement would have been £400. And let's say that we only had exactly £400 in our trading account. Now the price of the instrument we're trading has fallen by 100 points to 7,900. This means that we're sitting on a loss of £100. This loss will eat into the margin requirement. So that £400 deposit we made is now only £300. UK brokers are obliged to automatically close out your position if the funds in your account fall to 50% of the margin requirement. You should get a margin call before this happens, but if markets are moving fast, you may not have time to top up your account. That's why it's important to have enough funds in your account to cover your margin and to allow for trades to move against you, as it's not unusual for trades to show a loss before moving on to a profit target. I hope this shows that margin is a powerful way to get the most from the markets, but also that it needs to be handled with care. UK brokers have to follow strict rules on how much margin they can allow investors to use, so if you're trading with a regulated broker, your account will have this added security. But the golden rule, with trading on margin, is to always use a stop loss. On a buy trade, going long, this will be an order to your broker to close out if the price moves down too far, and on a sell trade, going short, it will be an order to your broker to close out the trade if the price moves up too far. I hope you're now feeling more confident trading on margin. If you'd like to test your knowledge, just follow the link below to take my margin trading test, and check out the Traders Bulletin website for more tips, techniques and strategies for success in the markets. Thanks for watching.